right? Straight line method is used for those heavy tech machinery, for example, auto manufacturing parts and all those stuff. So because they're going to be used for a number of years and they generate, stable revenue. So we use straight line method for evenly generated revenue in plants and machinery. But unit of production is going to be used for those plant and machinery who are going to be, wear out as they use more. For example, we have vehicles, we have plant and machinery, those who are based on number of hours to work. For example, AC, we have LCDs, we have lights, all right, lighting facility, heating facility. So these kind of stuff we use unit of production method. So you see, straight line generate evenly depreciation unit of production according to their use and accelerated. It generate highest depreciation early years and then lowest later on. So if we compare methods with number of usage, how many people use straight line method, how many companies use straight line method? So in US, so depreciation method, straight line depreciation, 88% companies use straight line depreciation, 7% use accelerated, 4% use unit of production method, and 1% use others uniquely defined depreciation methods. All right. So let's talk about the illustration here so that we can easily do that. So Ralph Pizza bought a used Toyota delivery van on January 2nd for $13,000. The useful life of van is 5 years. At the end of useful life, the estimated residual value is 1,000. Prepare the schedule for depreciation expense per year. So for 5 years, we can generate that. The first straight line method, we need to find out depreciable amount. So 13,000 minus 1,000, answer is 12,000 depreciable amount. Right? Divided by 5, answer is going to be per year depreciation expense. So that would be equal to 2,400. So 24. All right. And if you want to find out through rate, the rate is, if you want to find out through rate, find out the depreciable amount and multiply it with straight line rate, which is equal to 1 by life. And 1 by life is 5 years, is equal to 20%. So you multiply 20% to the depreciable amount, not to the cost. If you apply to the cost, that would be wrong because this is straight line depreciation. In double declining method, we do that with the cost, not with the depreciable amount. You see, this 12,000 is depreciable amount. You multiply with the rate. All right. So depreciable expense is going to be evenly distributed. And what is the accumulated depreciation? 2,400 is going to be added on every step, unless that the accumulated depreciation is equal to depreciable amount. And book value remain at the end of the year, at the end of the final year will be residual value or scrap value. All right. Simple. Now, if we use the same Toyota delivery van, but with unit of production method, remember the used van going to be run through 100,000 miles. So first year it travels 15,000, second year 30,000, third year 20,000, fourth year 25,000, and fifth year 10,000. So what we need to do, we need to find out depreciable amount minus So the cost minus solid value, this is the depreciable amount, and divided by total life in number of units. So answer is going to be 0.12 per mile. So you just write down the miles driven every year, just multiply it, and at the end you will get salvage value. All right. So the more you drive, the more would be the depreciation. So see, the more you drive, the more would be annual depreciation. The more you drive, the more would be depreciation. Entry is the same. Depreciation expense to accumulated depreciation. If you double declining method, so double declining method, DDM rate gonna be 1 by life multiplied by 2. So 1 by 5 multiplied by 2, answer is 40%. 40% of cost, not depreciable amount. So you see, now the depreciable amount is going to be 13,000 minus this annual expense. So the beginning value also changes, and at the end the value is going to be 1,000. So the last depreciation is going to be the difference between salvage value and the book value, 685. All right. The answer is 674. We cannot write 674 here. Why? Because then the salvage value is going to be more than 1,000. So we write it down 1,000. The last depreciation value is going to be the plug figure. That's it. All right. Now, other issues in accounting for the plant assets. Number one. So we, in our previous example, used 5 years. What if they have long life? We wrongly calculate the 5 year. Maybe after 5 years, if we run properly, use wear and tear, maintenance and other stuff is quite good. So then you realize after 5 years, it can run 2 more years. Then our analysis is changed, right? And remember, depreciation affects the income taxes as well. So you see, sir, see, if I make you understand from here, by comparing the methods here, so in first year, profit going to be lower in, extremely lower in DDM. Why? Because expense is higher. When expense is higher, profit is low. When you apply taxes, absolute dollar tax is going to be also low. All right. And if you see, straight line method evenly reduces the profit, so tax is going to be evenly paid here. So tax savings is not going to be here. But here, you can use those taxes. You can show to the government that you are using accelerated method, and early years you are paying lower taxes, right? Maybe you can have some kind of mind in here when we reach out here. So we change the method to straight line or unit of production. You cannot do that. If you find out that you are concealing taxes, you are stealing from the government, you will be penalized, right? You will be fined heavily. So yes, but total taxes remain same for 5 years. If your total tax is going to be same, but the tax is going to be paid evenly in straight line, unit of production according to usage, but in double declining method, early year tax is going to be paid low. And you see, later on, the depreciation is small, so profit is going to be higher. The later years, they have depreciation 8,000 and they have 3,000, 4,000, right? So their profit is going to increase, so dollar tax is going to be also increases in later years. All right. So you need to prove to the government that whether you are sticking to the same method or you are changing to the other method here. After here, you are changing to the other method so that you have to pay lower taxes. So that's government won't allow you. But some people do that. If you are caught, that is illegal because it is under concealing the taxes. All right. Oliver, you understand? Subhan, Mirko, Marco, Venetia, Havarun.
Yes.
Yes, sir.
All right, Nina.
Yes.
Okay. So what if? So this we just talk about that. What if we talk about that? Okay, we are going to sell our asset at 1,000. What if the asset is going to be sold at 500? You planned it that the salvage value going to be 1,000, or what if it is 2,000 rather than 1,000? Right? Then we call this gain and loss. It will be, we will make a separate entry. Plus, international accounting changes in future. For example, the accounting standard will say to you, okay, you cannot use double declining method on this equipment, on this plant, on this type of assets. Then you totally change all the stuff. All right. So tax saving is that accelerated depreciation provides faster tax deduction, right? So which means tax deductions decreases the tax payment. So tax savings can be reinvested in the business because the more you charge depreciation, the lesser going to be the depreciation. So first year you will pay less taxes, all right? So it means your tax expense and tax payments are different. We will learn all this stuff in our interest payment and interest expenses in our long-term liability stuff as well. But remember that one, tax payment is something else, tax expense is something else. All right? Because for tax purposes, we make two statements. All right? One income statement is for government department and one income statement is for public use. All right? If government allow you to pay you the lower taxes, so it means in future you will be paying higher taxes. So if right now you are paying lower taxes, so extra taxes you will save it with the bank, earn some interest, profits, and when you pay heavy amounts, so that is going to be saved from investment. So that is called tax saving. Early you pay lesser amount, the bigger amount you save it with the bank, return some, earn some money, and when the huge payments are coming, so you take it out and pay the huge money and you receive some kind of savings. All right. So only tax saving is possible in accelerated depreciation method. So if you see here, the depreciation methods, tax savings here, so we have an income statement here. So you see, sales are both here. One, one company is using straight line, other is using accelerated method. So you see here, the income tax expense here in straight line 27,000 and in accelerated it is 25,000. All right, it means there is lower taxes in accelerated method early years. I'm talking about early years. All right. So if you see here, so but if you see in the cash flow from operations, cash flow from operation here. So cash flow from operation is highest in accelerated. And remember, cash is the blood of any organization. Profit is something else. Cash is something else. So you see extra cash is provided, and that cash is because the difference between straight line and accelerated method. So this you can